When choosing between a single-family office and a multi-family office, the decision usually comes down to control, cost, privacy, and the level of responsibility that the family wants to retain. A single-family office serves only one family through a dedicated team and private infrastructure, while a multi-family office serves several unrelated families through a shared professional platform. Both models can centralize investment, reporting, governance, succession planning, and cross-border coordination, but they operate very differently. My name is Shiraz Waheed and I'm the co-founder at Lepidus Wealth. And in this video, I'm going to explain how both structures works, the practical differences between them, and the advantages and limitations of each model, and how to decide which approach is more suitable for your family. Now, before going into details, first let us to understand what a family office actually is. A family office centralizes the management and coordination of families' financial, legal, administrative, and governance affairs. Its role may include investment oversight, consolidated reporting, cash flow planning, banking, tax planning, estate planning, insurance, and company administration, as well as helping the founders and the families with philanthropy, property management, and succession. And it may also coordinate trust, foundations, holding companies, SPVs, and personal assets located across different jurisdictions. The family office does not normally replace lawyers, trustees, accountants, or tax advisors. It creates a central point of oversight so that these professionals work with consistent information and follow the family's wider strategy. The scope can be narrow, focusing mainly on investments and reporting, or much broader, covering almost every financial and administrative matter connected with the family. Now let's discuss a single family office that is usually called an SFO. It is established exclusively for one family. Its employees, systems, investment policies, reporting procedures, and governance arrangements are designed around the needs of the family. The office may employ a chief executive, investment professional, accountants, legal advisors, and other operational staff depending on the family size and complexity. Because the office serves only one family, it can be highly customized. You can decide how reports are presented, how often meetings takes place, who approves investments, and which matters requires family consent, and how responsibilities are divided between family members and professionals. An SFO can be designed around the family's operating businesses, private investments, and succession arrangements. This level of customization is one of its strongest advantages, but it also means that the family is responsible for creating and maintaining the organization. On the other hand, a multi-family office that is usually called an MFO, it provides family office services to several unrelated families through one established organization. Instead of recruiting an internal team and developing private infrastructure, the family uses the professionals, technology, systems, and external relationships that are already maintained by the provider. The services of an MFO may include portfolio management, consolidated reporting, tax coordination, estate planning, companies administrations, as well as banking coordination and access to specialist advisors. The exact scope depends on the provider, its internal capabilities, and regulatory permission. An MFO can offer access to wider team than many family offices could justify employing directly. It may already have investment professionals, accountants, analysts, compliance specialists, and relationships with banks, trustees, and lawyers. The family receives professional support without having to build every function internally, although the service will usually operate within the provider's established framework. Now, when discussing differences, control is one of the main differences between SFO and MFO. With a single family office, the family controls the organization, selects the staff, approves technology, defines reporting standards, and establishes the decision-making process. The office can be adapted as the family circumstances change, without having to fit within a service model designed for other clients. This can be particularly valuable for families with operating companies, direct private investment, complex ownership structure, or specific government requirements. In a multifamily office, the family still controls its assets and major decisions, but the service itself is delivered through an external platform. Reporting formats, meeting schedules, investment processes, and administrative procedures may have some flexibility, but they are unlikely to be completely customized. You should therefore understand which service can be customized and which follows the provider's standard processes before entering the relationship with an MFO. Now, a single family office can provide a high level of privacy because the employees and systems are dedicated to one family. Sensitive information about investments, businesses, distributions, succession plans, and family relationships can remain within a controlled internal environment. However, an SFO still works with banks, trustees, auditors, and other external parties, so privacy depends on strong access control, cybersecurity, and confidentiality arrangements. A multifamily office holds information for several client families, which makes data separation and internal controls particularly important. You should understand who can access your records, where information is stored, how electronic communications are protected, and what happens when an employee leaves the provider. A professional MFO should have clear procedures for confidentiality and conflict of interest, but the procedures should be reviewed rather than just assumed. A single family office normally has a higher fixed cost because one family funds the entire organization. organizations, salaries, technology, office space, and other accounting and legal requirements. The cost can increase significantly when the office employs an internal investment team or manage complex international structures. An MFO spreads its infrastructure and professional cost across several families, making it more efficient for families that want coordinated support without operating a full private organization. Fee may be charged through a fixed annual retainer, percentage of asset, investment management fee, or a combination of these methods. You should review the complete fee structure, including the charges from third-party advisors, custodians, fund managers, or administrators. You should also ask whether the MFO receives commission, referrals, product fee, or other forms of compensation that could influence its recommendation. Now, single-family offices provide dedicated attention because its professionals works exclusively for one family. They can develop a detailed understanding of the family's businesses, assets, relationships, and long-term objectives. The limitation is that a smaller internal team may not have specialist knowledge in every area. It can be difficult to employ full-time experts in international tax, private markets, cybersecurity, estate planning, risk management, and legal structuring when those skills are only required occasionally. A multifamily office can provide access to a broader range of professionals because the team serves several families and handle a wider variety of situations. It may also have stronger purchasing power, more established reporting systems, and greater access to external investment managers. However, these professionals divide their time between clients, so the family should understand the level of attention it will receive, who will manage the relationship, and how quickly the provider can respond when important decisions are to be made. A single family office allows families to create their own investment and governance process. It can establish an investment committee, define risk limits, approve asset allocation policies, select banks and custodians, and create specific procedures for direct investments and operating businesses. This can be useful when a large part of family's wealth remains concentrated in a private company and the wider investment portfolio needs to be managed around that exposure. A multifamily office, on the other hand, normally provides an established investment process that may include strategic asset allocation, manager selection, risk analysis, and access to private market opportunities. You should establish whether the MFO provides advice while you retain final approval or manage the portfolio under a discretionary mandate. The agreement should clearly define investment authority, restrictions, liquidity requirements, reporting duties, and the process of transferring assets if the relationship ends. A family office should connect with the family's wider ownership and succession structure. Assets may held through trust, foundations, holding companies, or special purpose vehicles. Each structure may have different decision makers or legal responsibilities. SFO can build governance directly into its internal organization through board, family council, investment committee, and written procedures for resolving conflicts. It can also prepare younger family members for future responsibilities and create continuity if the founder becomes incapacitated or dies. An MFO can support the same process by organizing meetings, preparing reports, recording decisions, and coordinating with legal and tax advisors. The family should still retain appropriate oversight and ensure that the MFO authority is clearly limited. Succession planning should also cover the office itself. SFO needs continuity if a senior employee leaves, while with MFO, relationships need protection if provider changes ownership, replaces relationship managers, or stop offering a particular service. Regulatory treatment of family office varies between jurisdiction and depends on the services being provided. Investment advice, asset management, arranging financial products, and services that are provided to unrelated families may require regulatory approval. This is especially relevant to multifamily offices because it serves several clients and may carry out regulated financial activities. You should confirm which legal entity provides each service and which regulator supervises it, as well as the activities that fall within its license. A single family office serving only one family may be treated differently, but exemptions and definitions vary. Dubai and the wider UAE offer structured and global recognized options for international families, including family wealth frameworks within DIFC and ADGM. The jurisdiction can also be used alongside foundations, holding companies, SPVs, and regulated investment providers. The family office location should still be coordinated with tax residency, domicile, asset location, reporting obligation, and the jurisdictions of the underlying structures. Now, when it comes to choosing between the two options, a single family office is generally more suitable when the family requires extensive customization, dedicated employees, direct control, and a high level of internal oversight. It may also suit a family with significant operating businesses, concentrated investments, and several generations, or a large number of entities offices and family branches. The family must be willing to manage employees, technology, governance, and a substantial fixed cost base. A multifamily office is generally more suitable when the family wants professional coordination, broad expertise, and established systems without creating a complete private organization. The decision should be based on the complexity of family's affair rather than wealth alone. You should consider the number of jurisdictions, the legal entities, investment type, family members involved, reporting requirements, and decisions requiring regular coordination. You should also decide whether the family wants to operate an organization or supervise an external provider. Ultimately, the chosen model should provide clear authority, reliable reporting, coordinated execution, and continuity across generations. So if you want our help and would like to set up your family wealth structure, you can request a personalized asset protection plan by clicking the link in the description below. That's it for today, and I will see you in the next video.